We're constantly bombarded with the next big investment opportunity, aren't we?
Oh,
The latest hot new product, maybe, that promises these huge returns, or some incredible new trend that just whispers, overnight wealth.
mm, it's tempting.
It is tempting. But for those of us serious about building real lasting wealth, the question isn't really what's hot, is it? It's more like what actually works,
Hmm.
safely and sustainably.
Exactly. And while that lure, that pull of quick riches is so powerful, the reality is that these, well, get rich quick schemes,
Mm,
particularly in investing, they often end up in what Benjamin Graham just called a
a
fiasco.
fiasco. With
Think about things like the January effect. Remember that?
vaguely, yeah.
This theory that you could get big gains piling into small stocks in January, well, turned out to be, inconsistent, often led to disappointment. Or even the idea that skill, just pure skill and brains, consistently repeats in fund performance.
Right, you'd think it would.
Our gut tells us it should work that way, but history just shows it doesn't, really.
Okay, so given all that noise and all these approaches that seem to fizzle out, what if we looked at a formula that has actually proven itself consistently
Mhm.
for building wealth long term, safely, step by step?
Yeah.
So today, our deep dive mission is exactly that. Let's unpack what it really means to, well, retire rich, slowly. We want to cut through the complexity, get down to the bedrock principles.
And for that, we're tapping into some serious wisdom. Two giants who really shaped modern investing, John C. Bogle, the visionary founder of Vanguard, and Benjamin Graham.
The father of value
He's
investing.
the father of value investing, author of The Intelligent Investor. Their insights, they aren't about chasing fads. They're practical, common sense principles, stuff that's really stood the test of time, offering a path to getting rich slowly.
All right, let's dig in. First stop, I think, has to be understanding this power of patient investing. Graham had this fantastic concept, the market as a pendulum.
Hmm.
So if the market's this swinging pendulum, what's the intelligent investor supposed to do? Just ride the wave? Or is there like a smarter way to handle those swings?
Well, what's fascinating is Graham's observation that the market, it hardly ever stays balanced. It really is like a pendulum, always swinging between unsustainable optimism, which, drives stock prices way too high and makes them too expensive.
Right.
And then it swings the other way to unjustified pessimism, which pushes them down, making them too cheap.
So it's not about trying to predict the exact moment of the swing, but more about recognizing where the pendulum is.
Precisely. The intelligent investor, they're a realist, not a fortune teller. They use these swings, they calmly sell to the optimists when prices get bugly, and then they buy opportunistically from the pessimists when stocks are on sale.
Makes sense.
Graham was really clear, warning against trying to forecast market movements. He basically said the average investor just can't succeed by trying to predict price movements.
And he had good reason for that warning, didn't he? He reminds me of those new era investment theories that pop up,
Oh, yeah.
like back in the late 1920s, leading up to the crash.
Right, the 1927-1929 market. It relied on ideas like common stocks as long-term investments. But as Graham pointed out, there was a radical fallacy in there.
Which was?
This notion that how desirable a stock was had nothing to do with its price.
Wow, that seems crazy now.
It does, and it's a powerful reminder history often rhymes, doesn't it? We see similar bubbles today when people forget that a stock's value isn't just, floating free from its actual business.
Absolutely. And the core lesson from back then, and really from Graham's whole philosophy, seems crystal clear.
Hmm.
He said, never buy a stock because it has gone up, or sell one because it has gone down.
Exactly. That emotional reaction, that's the opposite of intelligent investing. It's about being objective when everyone else is getting emotional.
Okay, speaking of emotion, Bogle brings in another crucial piece, and it might surprise some people. Time. He famously said, invest you must. Why is just not investing, not putting your money to work, such a huge risk, maybe even bigger than market ups and downs?
Well, this is fundamental for everyone listening. Bogle really hammered this home. Start early, even if it's just small amounts. Why? To let compound interest work he called it its miracle.
The miracle of compounding.
Yeah, like to get to, say, $500,000 by age 65, if you start investing at 25, you might only need about $43 a month in stocks.
Only $43, seriously.
Seriously, but compare that to just putting it in a savings account, you'd need maybe $328 a month to hit the same goal.
Wow.
The difference is it's staggering. That's the exponential power of compounding over decades.
That really puts it in perspective. Truly staggering. It shows the magic, like you said.
Mm.
But if time and compounding are so powerful, What's the biggest enemy? What threatens this long-term approach?
Bogle pointed straight at impulse and emotion. He urged investors, eliminate emotion from your plan, have rational expectations, and definitely don't change those expectations just because the market has its seasons. The cold, dark winters eventually give way to bright, bountiful springs. Stick to the plan.
Right. Stay the course.
But he also talked about the tyranny of compounding, which sounds contradictory at first.
Tyranny. How so, if it's magic for returns?
But it's tyrannical for costs and taxes.
Okay, got it. Explain that.
He showed how even tiny differences in the compound rate, especially when they're caused by fees and taxes, lead to really staggering differences in how much capital you actually build up over time.
So like a slow leak you don't even notice.
Exactly, like a tiny invisible vampire just slowly draining your portfolio year after year. It sounds dramatic, but the numbers bear it out.
So those little percentage points, they really do add up to a huge impact later on.
They absolutely do. Think about this. $10,000 invested maybe gets a 12% market return over 25 years. Sounds great. But after you factor in expenses and taxes, your final amount might only be 37% of what the market actually returned before those costs.
Only 37%.
And stretch that out to 40 years. It could be as low as 23%. So instead of maybe $931,000 pre-cost, pre-tax, you end up with just $217,200.
That's the difference between a comfortable retirement and
it absolutely is. The difference between nearly $1 million or maybe less than a quarter of that, that's how these seemingly small things have such a tyrannical impact on your actual life goals.
Wow. Okay, that truly underscores how critical costs are.
Yeah.
Which brings us perfectly to John Bogle's whole vision for Vanguard, right? Because he got this deeply.
He really did. A true pioneer. Vanguard, it operates differently without a profit motive.
Which is unusual in finance.
Very. Bogle believed this structure was crucial for investors to get a fair shake. He argued that when the company's profit motive comes into conflict with fiduciary responsibility, a fancy way of saying looking out for the client, well, then greed wins and profits triumph, usually at the investor's expense.
That's a stark contrast to the usual model.
Yeah.
It's about aligning interests. And this idea, costs matter, it's like this unseen drain. Both Graham and Bogle really documented this meticulously.
Yeah, they both saw high costs as a main reason most funds just don't beat the market. Bogle gave clear data. Average equity fund expense ratio, maybe 1.5%, lowest cost. Around a 0.2%, highest, maybe 2.2% or more.
That's a big spread.
It is. And he noted that just 1 percentage point difference, people tend to trivialize the impact of cost. They think, oh, it's just 1%. But it's absolutely not insignificant.
And the numbers prove it. Like that example, a 65% stock, 35% bond portfolio. Low-cost program, 0.2% expense, gets an 8.2% return. High-cost, 2.2% expense, only gets 7.3%.
Right. And over decades, that seemingly small 1.3% difference compounds into a huge chunk of your potential wealth.
And it's not just the obvious fees, the expense ratios, is it? There are hidden costs, too.
Definitely. Portfolio turnover, for instance. How often the fund buys and sells stocks. For active funds, it averages around 80% a year.
80%? That's a lot of trading.
It is. And all that trading adds costs, transaction costs, may another 0.5% to 1.0%. So you combine that with the expense ratio. Bogle called it an aggregate fiscal drag of potentially more than 3% per year.
A fiscal drag, I like that term. It's literally dragging down your returns. Over 3% a year, just vanishing into costs.
Precisely. And Graham's analysis, way back when, basically said the same thing. The typical fund has to beat the market by 3.5 percentage points per year before cost just to match it after costs.
That's a massive hurdle before you even start.
Huge.
And then there's the tax problem on top of that.
Yes. Actively managed funds, because they trade so much, tend to be tax inefficient. They generate all these capital gains distributions that taxable investors have to pay taxes on year after year.
Even if you haven't sold the fund yourself.
Right. Whereas passively managed index funds, with their super low turnover, are naturally tax efficient. Bogle showed over 15 years, the original Vanguard S&P 500 fund beat 94% of funds before taxes, but 97% after taxes.
So the tax efficiency gave it an extra edge.
A significant one. Taxes are like the black sheep of the industry, he said. Managers often ignore them, but investors absolutely cannot afford to turn a blind eye.
And this hidden drag, the cost, the taxes, it often seems to go hand in hand with complexity, doesn't it?
It really does. Bogle warned about the relentless pursuit of unrealistic performance, often done through costly short-term strategies. And he said this distracts everyone from one of the most important secrets of investment success: Simplicity.
Simplicity. Keep it simple.
Yeah, it's almost like the industry benefits from complexity because it confuses people, makes it harder to see what you're really paying for. They're always pushing hot new products, complex structures, think absolute return funds or leveraged funds.
The ones that promise the moon.
Exactly. But Bogle observed these often lead to really disappointing results for the actual investor.
You know, Graham said something similar about complexity.
Okay.
He said in all his years on Wall Street, he never saw reliable calculations about stock values that needed more than like simple arithmetic or basic algebra.
Right.
And if he saw calculus or higher math being used for investing, he called it a warning signal.
A warning signal, basically saying someone was trying to make speculation look like legitimate investment, substitute fancy math for actual experience.
So simplicity isn't just nice. It's actually a core strategy, a defense mechanism.
Absolutely.
Which brings us right to the heart of Bogle and Graham's solution, the indexing advantage. And this really challenges that common belief, the one so many investors hold on to, that past performance predicts future success.
That belief is deeply ingrained. But Bogle was so clear. There is no evidence, none, that superior past performance is predictive of future success.
None.
None. In fact, the opposite pattern is usually at play. Reversion to the mean.
Reversion to the mean. So things tend to go back to average.
Pretty much. Top-performing funds, they tend to gravitate to average gross returns. And because their costs are often higher, that means they end up with below-average net returns for the investor.
Can you give us an example of that actually happening?
Sure, the story of Legg Mason Value Trust is pretty dramatic. It beat the S&P 500 for 15 years straight, 91 to 2005, became this huge industry darling.
15 years is impressive.
Very. But then, from 2006 through 2008, it lagged the index by an astonishing 43 percentage points.
Ouch. 43 points.
Huge, painful swing for anyone who chased that past performance.
And Graham's own data, even from earlier times, showed the same thing, right? Only a small fraction of active funds actually beat the market long-term.
Yeah, something like 14.9% over 20 years. And he pointed out even that number is too high because hundreds of failing funds just disappear from the databases. They don't count the losers who shut down. It's survivor bias.
Right, you only see the ones left standing. What about things like Morningstar ratings? People rely on those stars.
Well, Bogle's research showed they have little predictive value, buying 5-star funds when they get the rating and selling when they lose it. That strategy actually produced below-market returns at above-market risk.
So chasing stars is basically a losing strategy too.
It seems so. It's essentially a strategy for underperforming.
Okay, so if active management struggles so much to consistently beat the market, especially after costs and taxes, why does indexing work so reliably?
The logic is actually beautifully simple, profoundly simple, really. Bogle put it this way. All investors, as a group, cannot possibly outpace the total cost-free return on the entire stock market. It's just math.
Right, someone has to be average.
Exactly. So he said, if you can't beat the market, why not join it? Just own the whole market through an index fund. You capture its full return minus very low costs.
And that cost advantage is just massive over time. We talked about 0.2% for index funds versus maybe 1.0% or more for active. That difference, thanks to that tyranny of compounding on costs.
It translates directly into significant long-term outperformance for the index investor. You keep more of the market's return.
Like that concrete example, $10,000 in an index fund grows to maybe $153,100. Same money, same time, in an average active fund. Only $113,700.
Right. That's almost $40,000 less, purely because of higher costs. Think what that means over a 30 or 40-year investing life.
Plus, index funds are more tax efficient, lower turnover.
Fewer taxable distributions hitting your account year after year. And critically, they tend to have substantially lower risks than active funds. Morningstar data showed over 30% lower risk over 5 years.
Lower cost, more tax efficient, lower risk.
And Graham himself, remember, emphasized diversification. For most people, spreading risk is key. He concluded the ideal choice for most investors is a total stock market index fund, a low-cost way to hold every stock worth owning.
Simple, diversified, works.
Pretty much.
And it's not just Bogle and Graham saying this. You hear it from other legends, too. Peter Lynch, maybe one of the best stock pickers ever.
He said most investors would be better off in an index fund.
Charles Schwab, founder of the biggest fund supermarket.
He said something like, only about 1 out of every 4 equity funds outperforms the stock market. That's why I'm a firm believer in the power of indexing.
Wow. When guys like that, titans of active management and fund distribution, agree, You really have to pay attention.
It tells you something fundamental is going on. But Bogle did offer a small word of caution about ETFs, exchange-traded funds.
Ah, right. They seem like index funds, but
They can be, but especially the ones designed for frequent trading, they can actually end up costing more. He cited examples of ETFs with expense ratios of 0.5% to 0.7% versus maybe 0.10% to 0.15% for a classic plain vanilla index fund.
and he also found that ETF investors themselves often lag the fund's return because they trade too much.
Exactly. Their own trading behavior hurt them, sometimes by as much as 4.2% per year over 5 years. That adds up to a 20% loss of capital just from trying to time the market using the ETF.
So it comes back to behavior again. The tool might be okay, but how you use it matters. The ease of trading ETFs can tempt you into that emotional, impulse-driven behavior that kills long-term returns.
Precisely. Which leads perfectly into our final, really crucial point. Taking personal control of your own investment journey, understanding the industry's incentives, and our own behaviors.
Because the mutual fund industry, as Bogle pointed out, has this built-in conflict, right?
Right.
The profit motive comes into conflict with fiduciary responsibility.
Yeah. And when that happens, he said, greed wins and profits triumph. Often, the investor loses out.
That's a pretty stark assessment. So what can investors actually do? How do you empower yourself against this?
Well, Bogle was a huge advocate for shareholders being more informed, more engaged. He actually encouraged people to read those dense proxy statements.
Really? The ones filled with legalese?
Yeah, even if they are rife with torturous prose, as he put it. He believed if investors understood the fees, they'd just say no, or vote with their feet and force the industry to treat them better.
Knowledge is power.
It is. And Vanguard's unique structure, where the funds themselves own the management company, that's empowerment in action. It aligns interests, and it results in huge savings. Bogle estimated upward of $3 billion per year compared to industry norms.
Wow. And Warren Buffett thought it could be even more, like $30 billion a year if others did the same.
Yeah, Buffett threw that number out there. It just shows what's possible when the investor truly comes first.
That's the power of aligned incentives. And on a personal level, Graham really stressed sound judgment, didn't he? His core idea was investing based on protection.
Protection, yeah.
Yeah.
Protection from overpaying for a stock, and protection from being overconfident in your own judgment. That, he thought, was the best approach.
Humility, almost.
And simplicity again. He stressed you don't need calculus or higher algebra, just simple arithmetic. If the math gets too complex, it's that warning signal again.
Maybe someone's trying to baffle you with brilliance or hide something in the complexity.
Could be. It might be speculation dressed up as sophisticated investment. If it sounds too complicated, maybe step back.
Avoid the fancy pitches. This all ties back beautifully to Bogle's philosophy, too, about serving clients as actual human beings.
Right, as honest-to-God, down-to-earth human beings, each with their own individual hopes and fears and financial goals. He said, treat them as we would like the stewards of our own assets to treat us.
It's a servant mindset, he called it, not a predatory one.
That mindset is everything. It's about building trust, long-term relationships, putting the client's well-being first, not just chasing quick profits at their expense. It's the total opposite of the get-rich-quick noise out there.
Okay, so let's recap this deep dive into Bogle and Graham. The core message seems incredibly clear. Building wealth slowly, patiently. That's really the only proven plan that reliably works.
Yeah, it comes down to patience, resisting those emotional impulses, embracing simplicity, definitely using low-cost indexing, and just taking an informed, disciplined approach to your own financial future.
All right, so that leaves us with a final thought for you, our listeners, to ponder. Given everything we've heard that the industry has often ignored costs and taxes, these black sheep, and that even star managers usually just revert back to average, what responsibility do you personally have to demand transparency, demand simplicity from your investments, from your financial providers, instead of just, hoping against hope for some secret shortcut that almost never actually exists?